Hey everyone and welcome. Today we're tackling a topic that sounds complicated but is actually pretty straightforward: investment portfolios. You've probably heard the term thrown around, especially if you're starting to think about your financial future. But what is an investment portfolio and why should you care? Simply put, an investment portfolio is just a collection of different investments. Things like stocks, bonds, mutual funds, real estate, and even things like cryptocurrency, all held by a single investor. Think of it like a shopping basket filled with different items. Instead of groceries, though, you're collecting assets you hope will grow in value over time. Now, why is this relevant, especially for those of us here in the US? Well, relying solely on savings accounts isn't usually enough to reach long-term financial goals like retirement, buying a home, or funding your children's education. Inflation erodes the value of cash over time, meaning your money actually loses buying power. Investing allows your money to potentially grow at a rate that outpaces inflation, helping you build wealth. But why not just put all your money into one hot stock? That's where the concept of diversification comes in, and it's the core of a well-built portfolio. Diversification is basically not putting all your eggs in one basket. If that one stock tanks, you could lose a significant portion of your investment. But if you spread your money across different asset classes, sectors, and even geographic regions, you reduce your overall risk. Let's look at a couple of simple examples. Imagine Sarah has $10,000 to invest. Scenario 1. Sarah puts all $10,000 into a single tech stock. If that tech company does really well, she could see a fantastic return. But if it struggles, she could lose a large portion of her investment. It's high risk, high reward. Now let's look at scenario 2. Sarah creates a diversified portfolio. She invests $3,000 in a broad market stock index fund, something that tracks the overall stock market. She puts $3,000 into a bond fund, which tends to be more stable than stocks. She allocates $2,000 to a real estate investment trust, or REIT, which invests in properties. And finally, she puts $2,000 into an international stock fund, giving her exposure to markets outside the US. This approach is less likely to result in massive gains quickly, but it also protects her from significant losses if one particular investment performs poorly. The goal isn't necessarily to hit a home run with every investment. It's to consistently grow your wealth over the long term with manageable risk. So how does it actually work? Well, you typically create a portfolio based on your financial goals, your risk tolerance, and your time horizon. Financial goals are pretty straightforward. Are you saving for retirement, a down payment on a house, or something else? The time horizon is how long you have to invest. If you're decades away from retirement, you can generally afford to take on more risk. Risk tolerance is how comfortable you are with the possibility of losing money. Some people are happy to ride out market fluctuations, while others prefer more stable, lower-risk investments. A young investor with a long time horizon and a high risk tolerance might have a portfolio that's heavily weighted towards stocks. Stocks have historically provided higher returns than other asset classes, but they also come with more volatility. An older investor who's closer to retirement might have a portfolio that's more heavily weighted towards bonds and other conservative investments. This provides more stability and protects their capital. There are many different ways to build a portfolio. You can do it yourself through an online brokerage account, or you can work with a financial advisor who can help you create a personalized plan. There are also robo-advisors, which are automated investment platforms that create and manage portfolios for you based on your goals and risk tolerance. And remember, it's not a set it and forget it kind of thing. You should periodically review your portfolio and rebalance it to ensure it still aligns with your goals and risk tolerance. Rebalancing involves selling some investments that have performed well and buying others that have underperformed, bringing your portfolio back to its original asset allocation. Let's quickly recap. An investment portfolio is a collection of different investments. Diversification is key to managing risk. Your portfolio should be tailored to your financial goals, risk tolerance, and time horizon, and it requires regular review and rebalancing. Building a diversified investment portfolio is a crucial step toward achieving your long-term financial goals. It's not about getting rich quick. It's about building wealth steadily and securely over time. It's a powerful tool that allows you to take control of your financial future and work toward the life you want. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.